Subscribe to my channel Report Stock.
All right, let's cut through the noise. We're digging into ABM Industries Q3 2025 earnings today, looking beyond just the raw numbers, to really understand their financial heartbeat, what's propelling them forward, and maybe some of the strategic tightropes they're walking. Our mission for you is to find those surprising aha moments from their latest earnings call and the analyst Q&A.
Exactly. And the source material here is it's incredibly rich. It offers a compelling blend, really, of strong financial indicators and some pretty intriguing strategic complexities. Our goal isn't just to report what happened, but, to distill why these decisions and outcomes are crucial for understanding broader corporate strategy and how companies adapt.
Okay, so let's jump right into the good news then, because ABM, well, they've delivered some impressive figures. They reported total revenue of $2.2 billion. That's a solid 6.2% increase year over year.
Pretty strong top line.
Yeah, and maybe even more telling, they achieved 5% organic revenue growth across all their segments. And get this, they've secured over $1.5 billion in new business just through the first 3 quarters. That's a 15% jump year over year. I mean, what's driving that kind of acceleration?
Well, what's fascinating here is how that top line growth seems strongly supported by operational efficiency. The company generated over $150 million in free cash flow. That's largely thanks to disciplined cash collection.
Oh, okay.
They even managed a significant 7% sequential reduction in day sales outstanding from Q2 to Q3.
So they're getting paid faster.
Much faster, yeah.
Yeah.
Which is, a powerful sign of improved cash flow. It frees up working capital for the business. And they're also looking ahead, investing in AI tools, not just for cost cutting, apparently, but to enhance client services and maybe drive future revenue, too.
That sounds like a company really firing on all cylinders. Yet, when we look at the adjusted net income, there's a slight dip, $51.7 million compared to $53.6 million last year. Plus, their adjusted EPS guidance for the full year, it's now expected towards the low end, like $3.65 to $3.80. It feels like a bit of a puzzle, doesn't it? Is this simply the cost of, aggressive growth, or are there deeper things at play, things compressing profitability?
This raises, I think, an important question for any growing company. The margin pressures, as CEO Scott Salmirs explained it, they seem to stem from 2 main areas. First, some strategic pricing decisions, and second, a slower than expected recovery in certain commercial office markets.
Which one specifically?
Particularly on the West Coast, the Midwest, and the Mid-Atlantic. This isn't just a blip, right? It kind of illuminates a core strategic dilemma. Do you fiercely defend existing markets, even if they might be declining, like maybe some office spaces? Or do you boldly chase new high-growth sectors, things like semiconductors and pharmaceuticals within their manufacturing and distribution segment, even if, it means accepting a temporary hit to profitability for future market share?
Ah, the classic trade-off.
It's a classic portfolio rebalancing act happening in real time, and we also see higher interest and tax expenses contributing to that pressure as well. Can't forget those.
Right. So they're navigating this complex landscape, making these deliberate trade-offs between immediate profit and that crucial long-term strategic positioning. How exactly is ABM managing these pressures? How are they mitigating them to stay on track?
Well, if we connect this to the bigger picture, they're not just accepting these pressures passively. ABM has launched a restructuring program that's expected to generate at least $35 million in annual run rate savings by year end.
Okay, $35 million. That's substantial.
It is, and it's not just a one-off saving, it's a structural improvement designed to boost their bottom line consistently year after year. CFO David Orr also expressed confidence in meeting their Q4 free cash flow targets about $140 million, so highlighting their continued financial discipline.
So they feel they have a handle on the cash.
Seems so. And Salmirs also made it clear ABM is prioritizing strategic partnerships through negotiations rather than just competitive bidding all the time.
Why that approach?
To maintain relationships, basically. It helps them avoid what he called irresponsible bids. It's a bit like a seasoned investor choosing long-term trusted partnerships over chasing every high-risk quick win, you see.
Right, understanding that true value often comes from those deeper relationships. Okay, so to summarize this deep dive for you, ABM Industries is definitely showing robust top-line growth and pretty disciplined cash management. But it's also clear they are strategically navigating a really complex market, making deliberate trade-offs between those short-term margins and investing in long-term market expansion and client relationships. It's not just about the numbers, is it? Is the strategic story behind them.
It's a compelling situation, yeah, one that, frankly, many companies face, and maybe something for you to consider. How do you think companies should effectively balance that aggressive growth, the strategic market entry, and protecting existing client relationships? Particularly when those choices inevitably impact short-term profitability in, well, today's dynamic economic landscape. Something to mull over.
Subscribe to my channel Report Stock.